Welcome back to another episode of Fun Friday with a great guest here, Jeff Ervick, managing partner at Valoris. Is that correct?
That's right. Yeah. How you doing, Craig?
I'm doing great. Great to see you today. We were reacquainted at Tampa Bay, Sam Silverman's event there. Shout out to our friend Sam, hoping that he does a similar event in Florida to get me out there in the November timeframe. It's a great time to be there. I'm sure you're not going to be complaining about that either. Seeing as that you're tucked away in the Northeast there in Maryland. Is that correct, I imagine?
That's correct. Yeah. Anytime I get down to Florida, even in the summertime, I don't really care if it's hot down there. I don't really care. I just want to get down to that area. I love the Tampa area too. So the more times we can visit that would be great. So Sam, if you're listening to us, yeah, invite us down for a weekend, right? Why not?
Yes, please twist my arm. But I will say, when it's nice like this right now, keep me in Arizona, and then in a couple months there, I'm going to be in Oregon, enjoying it, playing good golf there,
Oh,
and
good.
living my best life there, if you will. But let's get into your story, Jeff, there with regard to kind of your background, what you're up to. You obviously have a lot. You know, with the company, you're kind of wearing the investor relations hat, if I'm not mistaken. So let's just hear about yourself, your background, and kind of your origin story.
Yeah, no, I appreciate it. Yeah, so I've been in technology sales for over 20 years. That's been my kind of go to, my W-2. I've only been in two different companies in that 20-year span. So just came up on about 4 days short right here in March from my 10th year anniversary of my current company. Um, but I love the aspect of sales. I love building relationships. I mean, in sales, you're building relationships, whatever you're doing. So having a chance to be able to connect with folks on a different level than just a transactional level, it's more of like a human connection, more of a relationship connection. That's really what I'm about big time. Um, but from the real estate perspective, right? So to kind of talk about why we're here and talking about real estate from that perspective, I've been investing in real estate since 2017, and actually, I kind of joke. My wife and I bought our first house back in 2009, and we right before or right during the midst, so to speak, right of the first housing crash. But we got a good deal on it. We stayed it for like maybe I think we were there for like 15 months, and we ended up flipping it without realizing we were doing like a house hacking deal. So I guess technically that was my first real estate transaction, but in general, I've been in real estate since 2017, buying a bunch of rental properties. Is how I started single family rentals using the Burr method. Listened to a bunch of or bunch of Burt. The bigger pockets, how to flip a home. Burr method. Got into private lending, and I still hold a bunch of those, and I still private lend as well. But I was looking to get scale, right? Because I'm sure you're aware, Craig, scaling in a single family rental property portfolio is pretty
Doesn't
difficult.
exist.
It doesn't exist. Is that
You
yeah?
can scale your equity. I
Yes.
think homes.
Yeah.
People need to reevaluate, in my opinion, the perspective of single family homes investing.
Yeah.
You should do that for a equity appreciation play,
Yeah.
not a cash flow play.
Yeah. Oh, 100%. And that's the thing too, is like my portfolio has really good equity in there. Cash flows, it kind of sucks, right? Especially when somebody gets evicted or moves out. And I had to just do that last month and pay a $3,000, rehab bill. It sucks. It takes away all your cash flow for the year. So I looked at that and I said, you know what? I need to find some other way to be able to build my wealth faster and scale better. And that's where I got into multifamily. So started investigating that about 2 years ago, jumped into first property, raised for that property. And then through that raising, is how I met my partners at my company, Valoris Capital Partners. And we said, hey, why are we doing this separately? Let's do it together. Let's form a company, and let's do it together. And when you find people that have the same passion, the same motivation, the same determination as you, but have different skill sets, that is, I think, the key to success, right? When it comes down to building a good company.
Without a doubt. So a lot to unpack here. So loving it with kind of the background there. So you raised capital first for Valoris, and then you said, well, let's kind of get more serious about this.
Yeah, yeah. Well, it was actually kind of the other way around. I raised capital for just myself on a deal, and then through that, we as my partnership and we met raising for that same deal as all individuals, and let's say, why don't we do it together, and then work on acquiring deals, managing deals, transaction, the whole, start to finish for the deal, not just raising the capital of the deal.
Right.
Um,
Makes sense.
yep. And so that's
Okay.
kind of where where we've been moving for the last couple months.
So you were doing it that way. You had kind of a role there. It kind of grew to something larger. That's awesome. And I remember one, or just kind of noting on the first thing you said, which is creating real relationships with real people.
Yep.
And what really stuck out to me with kind of the start on your introduction there is you've had a roughly, you said, a 20-year career in tech sales, but you're with two companies. That's
Yeah.
almost never happened before because you hear people that kind of flip from job to job. One
Yeah.
offers you this, one offers you that, or particularly where I'm from originally, the Bay Area, and a lot of people that I know who have graduated from the area. You're at a startup here, you're at a different one 9 months later, maybe you're at one for 2 years, you're kind of looking for the pipe dream of a massive kind of pop there, maybe some work out, maybe it's some do. I've had some friends that have really struck gold there, metaphorically speaking, and have done quite well. But it doesn't always work that way. So 20 years at 20 years with two companies is pretty remarkable. So I can actually attest to the fact that you do value relationships, because I'm sure you like your managers enough. And, you look at people probably not as commodities, but as relationship-based investing. And when you start doing that, what happens is you get actually a lot better quality investors. You don't get commodity investors. You get people that are investing in you because they believe you and trust you. So I imagine a lot of relationships that you've forged over the time have been from that.
Oh yeah, 100%. I think the when you're doing technology sales, right? It's not just about like, hey, what product can I sell, or what is the service that I can wrap around that product to sell. You're really selling the opportunity to help the customer and help them figure out a pain point of what is the next solution that you can kind of craft together, and then also utilize your relationship to have a long-standing like customer, client, or even friendship. And that's the beauty about it. It's not a singular transaction. I think of like a car salesman or a realtor, right? How many times are you, unless you're working with a investor, real estate investor, or a car investor, how often are you going to go back to that one person and say, hey, I need to buy another house in 15 years, right? I need to buy another car in 5 years or something like that, right? It's not really a relationship base, it's a transactional base, right? So in my sales, I'm looking to build a relationship with a customer so I can have repeatable business, annually, or even multiple times per year, right? And then get into an opportunity where it's a reoccurring business, kind of like what we have with cash flow with the multifamily. That's a reoccurring sale, reoccurring business, because you have to be constantly touching, working with your residents, right, to make sure that they're happy, they're paying rent, they're doing their thing. You have to work with your investors, make sure they're happy, they're understanding where their returns are coming from, and you want that investor to work with you multiple times. You don't want to, get a singular check out of an investor, right? Your goal is to build a relationship. So if they already know you, right, that's a good thing. Hopefully they like you, right, because you're starting to, have that conversation and build a rapport with them, and then eventually they're going to trust you, right? And if they trust you, then they'll come back and they'll invest multiple times, and that's what we've been lucky on. And actually, I don't even say lucky. I hate the word luck, to be honest with you.
It's funny how
Yeah.
much luckier you get the harder you work, right?
Yeah, exactly. Yeah.
You've been
Well, because
fortunate.
yeah, exactly. Because I look at it as if it's when opportunity cost meets dedication, right? Or when you work hard and you meet that opportunity, that's what creates your own luck, right? So if you can combine those two, you will be successful. You just gotta find the right time and put the hard work in, and that opportunity will come when you're ready. It'll be there for you.
Yeah, certainly. I couldn't agree more there. And I think the theme here for someone to take away early on in this show, just from how you like to do things, Jeff, is similar how we could like to see the world here. And that's probably why you're such a perfect fit for the show, which is doing anything in life has to come with a compounding benefit. So whether it be any relationship with regard to an investor, if you're to take their dollars there, to do anything from a career perspective, or even have tenants there, you want to make sure everything you do is the right way to do it, but also have a compounding benefit where your life in return gets incrementally easier over time. You don't have to always go out and hunt for new business, so on and so forth, because you turn and earn people.
Yeah, that's true. But don't get me wrong. The hunt for new business is what also excites you as a good salesperson, right? So being able to develop a good relationship with somebody, or get that person on the phone that you have not been able to reach for 6 months, right? And eventually, that hard work and dedication will pay off, where you will become lucky, and hopefully they'll invest with you, or they'll buy something from you, or whatever it is, right?
Yeah.
Whatever it is you're doing in life. Yeah.
And I think treating relationships, particularly investors, capital partners, or other people like yourselves,
Yeah.
as just people and checking in with them, developing real relationships, you get the compounding effect. But what you also do is you start getting referrals, or your investors that you check in on want to retain with you. They'll want
Yeah.
to kind of overdo it. So if you're a capital raiser or a sponsor and you're not kind of routinely checking in with your capital people, the people that are kind of buttering your bread, you're making a big mistake, because guess what? Someone else is fighting and wants it, and we'll be reaching out to them. So
Oh yeah. Yeah, for
it's
sure.
not, I hate to say it's not a zero sum game, because I believe in the power of abundance, and there being tons of, money out there for everyone to kind of have a slice of the pie there. But realize that if you're not checking in with them, someone else likely could be, or they're seeing other ads, right? That's why marketing is so effective. So make sure that you're a squeaky wheel, that you have the right systems in place, and you're treating everyone the way you would want to be treated as a customer. I think it's super crucial. But yes, to your point, new business is the lifeblood of everything in this industry.
Yeah.
So making sure that you are always hunting, whether you're going to conferences or going to LinkedIn or wherever the marketplaces may be, getting in front of that. I mean, obviously you've gone to a good amount of conferences, you're kind of traveling and whatnot to make sure that, you're meeting people where they are, is a smart, wise way to go about things. But
Yeah.
let's get
Well,
into,
one other
yeah,
thing I want to add to that too is you have to be, when you get into this position where you are dealing with a relationship based business, you also have to make sure you're being authentic, right? If you're there just to get them to write a check, they're going to know that, right? They understand that. They're not dumb. They're not accredited investors for no reason, right? These investors know what they want. They know what they're looking for, right? And so you have to also, make sure you're really being an authentic person, because they can read through the BS, right? People can do that. And if they do that, then you're never going to be able to be successful in this business. So valuing relationships and being authentic are two of the things that I love about this business.
certainly. So let's get into Valoris and the deals that you've done. When did the company start? What are your products? Can you tell me about that? Kind of the focus, things of that nature, the high level.
Sure. Yeah. Yeah. We're just about 2 years old. So we've been in the game a little bit later, a little bit younger than you guys, right? So you guys have
You're
a
getting
couple.
into the right time, because getting
Yeah.
in 2023 or two is the best time to get it from a cyclical perspective. I'm sure you know all too well that timing in life is pretty important, right?
It sure is. Yeah. I mean, the deals from 21 and early 22 are pretty challenging from a financial perspective, right? But yeah, we got it. I feel like we got into it in the right time. And somebody once told me too, because a lot of people always say, like, "Oh, I wish I would have done this 20 years ago," and so forth, which is great to think about. But think about yourself. Were you ready 20 years ago to be in a position you are now, right? And I don't think 20 years ago I was in the position to be able to, speak the way I do now, or build a relationship the way I do now, or be able to gain trust the way I do now, right? So I think I'm in the perfect spot, perfect position in my life, in my career, to be able to do so. But with Valoris, we first got into our first deal, which is a value add, in Arkansas. We were partners, or we all kind of met separately, and we kind of came into the deal, help raise some capital, do some asset management, have some material participation in the deal. And then from there, we decided that, hey, that's where we can kind of stick our hat on, right? Is we should be able to look into these different type of value add assets, right? So we started doing that. We acquired another 128 unit in Jacksonville, Florida. We acquired another 48 unit in Minnesota. And as you can see, you can kind of hear they're in different geographical areas, right? Which is okay. I'll get to that in a second. And then we started to kind of hone in on our locations of where we want to be successful at. And we kind of looked at least 3 key states that we want to really focus on are Texas, North and South, well, I guess 4, North and South Carolina, and then Florida, right? So right now, those are the kind of areas we're focusing on. We then were able to, through partnerships, meet with a couple other key people who've been tremendous to our growth. And we've been involved, and we are involved in some ground up construction. So that's the second pillar of our assets that we have. So value add is our first kind of bread and butter. And then now we are being developers. So we're developing 370 units of Class A space in St. Pete. right outside Tampa, which is why I told you I love Tampa. So we've got 3 plots down there. There's 150, 60, 16-story Class A high rise or mid rise. Next door to that, we've got another 146 unit, 5-story garden style wrap building. And then about a mile from that place, we have another 74 units that we're developing. We're actually about to hopefully hit the construction here soon once we get the final permits done. So we're in that development space. We also acquired 72 acres, in San Antonio, Texas, where we're almost ready to apply for our permits and so forth. We're just restructuring a little bit of the architectural plans with our architects and our engineers. That's amazing because that's an 815 units of Class A multifamily, in set in 3 different phases, plus about 4 retail pads, which we might sell, or we might bring in a JV partner to do the retail side. So we've gotten into some development deals, right? So you can see the kind of trend we're going on, and then the next phase we got into was light industrial. So we ended up buying a warehouse in Charlotte, North Carolina, plus some land, which we're also developing into industrial land as well too. And crazy thing about that is that we bought that property in June. We're literally going to close on it in 10 days. So, to sell it. So we bought it in June, fixed it up, and we're selling it. So our first, exit in the industrial space is happening in like a week, which is amazing. So yeah, very exciting stuff. So, and we've also then acquired another, value add in Charlotte. We're under contract for another one in South Carolina. We're about to, we're also about to launch which is actually the next exciting thing we're going to do is we're launching our first fund. And being in the economic time where we're at right now, where there's a lot of uncertainty when it comes down to, and I'm seeing it now too with, and I'm sure you are also, with talking to some investors right now with the stuff happening in the market. Like, it's easy to say, hey, take your stuff out of the market and put it into real estate. But a lot of investors also don't want to sell their market. They'll adjust, and they'll figure out ways and strategies to adjust their portfolio, but they don't want to just pull it all out of the market, or else you're going to lose a lot of money or you'll pay a lot of taxes, right? So we've also seen a shift in that. So we're focusing on a private credit fund, right? So our private credit fund will be able to provide subordinate loans to senior debt on Class A assets with tax abatement strategies, right? So that way they pay guarantee returns to our investors, and we'll do a usually about a 14% average return, but it's 6% up front, 8% the back end. And then we'll also do gap funding. So we have some gap funding deals, some mezz debt deals, some of those sorts of things. So it's a private credit fund, which is amazing. So it provides a constant monthly cash flow for investors that have a little extra cash laying around, where they need to make a little bit more than what they're able to find in the treasuries right now. And they don't want to risk it in a value add deal that they won't see a return for a couple of years from now. So what do we do next? Let's find an opportunity to provide that cash flow. And it's something that I'm passionate about too, Craig. And I know I'm speaking a lot. I'm sure you're just dying.
No, I know. I love it. Listen, when my guests go off, it makes my life easier because we got a lot of follow-up questions here to go with.
Oh yeah. And so I mentioned earlier in my in our conversation too, is I did some private lending and so forth. I do some real estate stuff. So I've created a way for my personal portfolio to have multiple streams of income from different assets or different income streams totally, right? So I've got a W-2 that funnels money into my equity portfolio. I've got an equity portfolio that I can borrow against that goes into some private lending, to arbitrage the money there. I've got whole life insurance policies that I use to arbitrage and obviously do lending as well. I buy real estate for rental properties that has an income stream. We have short-term rentals, and then we're also doing our multifamily. But as you know, multifamily has a slew of different asset classes and ways to be able to diversify your portfolio in that as well. So I've created a booklet, an ebook that kind of goes through my background and what I've done. And people can find it from our website. It's valoriscapitalpartners.com. It's VALORS or VALORIS capitalpartners.com/next level. And that way you can kind of see our ebook. You can also find it from my LinkedIn Jeff Ervick as well too. But Craig, it's important for me to be able to diversify my family's portfolio, right? So that way I have multiple income streams and I'm helping other people do that same thing too, right? So that's why I got into ground up development. I got into value add. I got into industrial. I do private lending. I mean, it's all based on what I want to do for my own portfolio. I know that other people are trying to do that. They just don't know how to get there yet or how to do that, right?
Yeah, makes sense. So a lot to unpack here. So let's just go through it kind of high level, soup to nuts, kind of roughly in order. So multifamily, you said you're in a couple locations. What do you look for in a deal? What's kind of your niche there? Are you looking for, sub 100 units, above 100 units, below 200? Kind of what's the philosophy there? Value add, core plus, affordable. How do you kind of look at that?
Yeah, we've done a lot of value add, class C, class B, or class C that we're making into a class C, class B product. Workforce type housing. We've done that already. We like that model, but it also is it's a heavy lift, right? Because you have a lot of CapEx that needs to be involved. You've got to get different financing structures from bridge lenders, or you really can't go in with your traditional, institutional type of debt. So we're also kind of shifting our focus a little more on some core assets, right? So something more of the 1990, 2000 plus class B that just needs a little facelift, and we can provide, whether it's expenses with expense cuts with tax abatements on that one as well, or we provide a value add for being able to find under market properties, right? So that's the multifamily side for that. But I'd say primarily we've been doing value add. We are shifting our focus towards the higher level class B properties.
Makes sense. Yeah, I mean, the unfortunate reality in multi right now is that C and maybe B minus stuff, depending on the market it's in, is still hasn't really found its value, and a lot of those deals are going to get foreclosed or have to get workouts there, and that's kind of a tough situation to play in. There's not much liquidity there at the moment just due to the problems, and you kind of learn quickly that no one's really rushing to lose money on deals. No one's rushing to lose a property where there's an unfortunate outcome there. And a lot of sponsors are trying to get scrappy, whether it be doing loan mods, doing extensions, or putting in capital infusions to deals to basically make them work. It's very understandable, but that kind of creates a delay in the deals actually unfortunately coming to market. So that's one thought there. Let's get into industrial. Why industrial and where as well?
Yeah, so industrial, we've got Charlotte, North Carolina. So for me personally, I think even this goes on like 15 years ago. I was talking to my brother. My brother is an artist in Manhattan, and he was doing a bronze bust or a bronze figure for a gentleman out in Washington State. And he's like, Jeff, you would not believe the house I was at, this guy's property. It's amazing. This guy must be a multi-billionaire. I'm like, oh, what does he do? He's like, he owns a bunch of storage facilities, right? And so this was like in early 2000s. My brother was telling me this, right? Probably mid 2000s. And so from that time on, I'm like, I want to figure out how to go buy some type of warehouse or storage unit or something, right? And I just never got around to it. But then once I got into multifamily, I realized, hey, it's not much different than what we do for multifamily. It's actually underwriting is actually a little bit more simplified, right? Because you're not worrying about, 1,000 spaces of tenants that pay rent for themselves. It's usually a smaller transaction, but it's more of it's a business with a real estate attached to it. And better yet, instead of doing storage, is why don't we look at like light industrial or flex warehousing, right? Because it's a business that is utilizing the space, right? So they've got a reputation, they got revenue, right? So you have to have certain requirements for revenue and business reputations and so forth. So we got into the industrial side for that reason, and selfishly because I wanted to be a part of buying industrial, and so we found through our network we found a really excellent operator. Because again, I'm not an operator we're operator of multifamily, not of industrial. So we found a really amazing asset manager and operator of the industrial that we partnered with. We raised some capital. We signed on some debt. We worked with them to help provide, different asset management and so forth for it. So we've got a really good thing going on there.
So would you consider that more of a true joint venture setup effectively?
We raised capital through syndication. So we still did do it as a syndication, but yes.
Like or a co-GP setup?
Oh yeah. Yeah. Still co-GP. Yep. That's correct.
Very cool.
And then, And then we're also working. We have another partner who's based out of Jacksonville who approached us with building actually ground up development, a light industrial, flex industrial space. So we're looking into that as well too. So
Excellent. So let's talk about the deal that was industrial that you mentioned is going to come full cycle here, roughly.
yeah.
How long was that kind of structure? Obviously, we don't have to jinx about the return profile and stuff, but what made you guys identify that deal and kind of flip through it so quickly? Because you said, I mean, if you've been in business for roughly 2 years, get an exit quickly in this market is saying something. So we kind of talk about and harp on that success there.
Yeah. So like most real estate transactions, you make money when you buy it, not when you sell it. Right. So we were able to find an amazing opportunity for a kind of like a rundown, mismanaged warehouse it was a single tenant warehouse, 35,000 square foot that was in need of a very good refresh, let's call it, right? So we purchased the property. We cleared a bunch of the brush around a bunch of trees. We redid the driveway. We added a few doors, a few of the roll up doors for it. We redid the HVAC. We painted the exterior. We basically refreshed. We rehabbed the building, and we had it listed for lease or sale with our broker. We had a couple people jumping in to look at leasing the building, which we would have done. Triple net lease would have been great. But it turns out that the person that's buying it wanted to, they are a single tenant. So we were looking at maybe having it for like split, maybe 3 or 4 tenants in there, and some office space as well too. But they said, hey, we actually could use the entire building and we don't want to lease it from you. We actually want to just buy it from you. And so we're like,
Better. Sure.
Let's go for it. Right. Why not? Right.
Twist my arm.
Yeah, exactly. So the beauty about it, I mean, I'm not going to get into the specific returns yet, right? But we are able to return a lot of our capital back to our investors, initial capital that they put in, plus meet the preferred returns for the deal. But we also own phase 2, right? Phase 2 was another 10 acres that we purchased in a separate transaction, but under the same fund. And that one is currently under construction for what's considered like a laydown yard. So when you have a industrial company come in with a bunch of their heavy equipment or tractor trailers they need to park, or even like a landscaping company that has they need a singular small like building, right, that they can have an office, a bathroom, and a couple of the garage bays. So we're currently under construction for that for phase 2. And once we get to a certain point, we'll do the same thing. We'll list it for lease or for sale. And we've already got a couple leads for people who are looking to lease this one out. So that one might be a lease where then we'll collect it, for a couple of years and then list it for sale. Or maybe we'll just flip it and list it for sale once we have the lease signed up for a 5 or 15-year lease.
Yeah, fair enough. Sounds great. Well,
Yeah.
congratulations on the early success on that deal. And, to your investors who chose well there, having an exit or two really does help the fundraising process and kind of gives you more credibility, particularly now, I should say, when there's not a lot of deals going on. So let's talk about development. So development, Do you go soup to nuts, what in the development world, for those who may not know, you buy a piece of land, then you zone it, entitle it, give it shovel ready, and then you actually build, and then you lease up, then you sell. So is your goal to do that entire process? Do you buy what's called shovel ready dirt, which basically means you have the plans, you have the permitting, it's good to go? How do you look at that kind of process holistically?
I think it just depends on the deal itself, right? So if you're looking at a net new deal, usually that process, it takes a while. Like you can buy the dirt, fairly, I'm not gonna say inexpensive, but you can buy it cheaper than it would be if you have the entitlements done, right? But that entitlements process takes about maybe 12 to 24 months, right? So once you have it under entitlement, you can either flip the land to a developer, right? Or to somebody to go through and develop that property. And then once they are shovel ready, so there's 3 kind of phases. There's buying the dirt, there's getting the entitlements to build, and then there's shovel ready, which means you have all the plans and the permits done. So after that phase, then you can either develop it yourself or you can sell it to a large builder, and they're going to come in and buy it. So in every phase, you got like a step up, right? From what you purchased it for what it's worth now to what it's worth if you have under development. We've purchased both ways. We've done some dirt, right, and gone through the entitlement process. Like our San Antonio deal, we bought it as dirt, and now it's under entitlement phase. So we're currently going through the plans and permit side. A portion of our St. Pete project we purchased as entitled land, right? So the land was already entitled. It had your basic designs and basic architectural, so to speak, right, already done.
Basically allowed through the planning within the city, and then you could figure out the finishes and the schemes and the palette that you'd want to put on it, roughly,
That's
right?
right. Yep.
Yeah.
And right now with our architects and engineers, we're going through that process. So we're doing some small tweaks, right, to the exterior of the building, make it a little more aesthetically appealing. We're now talking about all right, let's all look at the SD sets or schematic sets, design sets, like where do plumbing go and how do you configure things on the interior of the building. And then once we get to a certain point, which we're already actually at that point already, we then go take that document, right, which isn't fully finished. It's not the full plans yet, right? But we take that document and we go bring it to our GCs and we say, hey, here's the project, bid it out, right? So give us your best quote, right, for that. And we did bring in and we partnered with a general contractor as our owner's rep. So he's not going to be building the project, but he's going to be our basically our eyes and ears and our everything when it comes down to when we start building, right? Having somebody on your team with that kind of experience, I think bodes extremely well for investor relations, and also for just knowing that the project is getting to be done correctly and on time and hopefully under budget. That's the goal. So then once we get to the position where we've got the general contractor set, and we'll go and get our funding for our construction loan, which that should happen the next 3 to 6 months, probably 3 months or so. And then we'll be able to then, once we get the plans kind of fully done, we'll be able to then go submit our permits to the county. That takes about 12 weeks or so. So it's not too long, right? Which is a good thing. It all depends, obviously, which company we use to submit our permits, right? So we're going to get that squared away. Our architects are phenomenal in the St. Pete area. And then once we're able to build, right, once we have the permits ready, we should, at this time, we're on target to get construction or at least break ground, so to speak, right, in December, January of 2026, right? So we're getting close to it, which is amazing. So yeah, so I'd say that's the kind of process you go through. But me personally, I'd love to be able to buy shovel ready and then build and go, because
You de-risk to a certain extent.
You do, yeah. You de-risk it, and also the time frame. But we've got investors who have been in the projects from the beginning, so they invested knowing that there was going to be no cash flow or or no returns until we get to a certain phase, right? Once we start building and we're almost completed, we'll start the lease up phase, and then once we're 90% leased, that's when we go and get our refinance to be able to cash out our investors. Provide the returns that we estimated for the opportunity, and or sell it. At that point, we can even sell the property then to an institutional investor, right? Since it's a Class A property.
Very cool. Now, final subject here, private credit fund. Private credit's become a lot more in vogue of late. So you mentioned kind of some of the items, but can you talk about the makeup of the deals that you invest from a private credit perspective? What you're looking for?
Yeah, so there's a couple of different tranches there. There's a like a mezzanine type of debt, or a loan that's subordinate to the senior debt, right? So it comes in the capital stack. You've got your senior debt, you have your pref equity, and then you have your common equity. So our loan will kind of sit in between pref and senior, right? And so that would be we are targeting Class A buildings, so Class A highly occupied facilities, right, that are well run, right? That way we know it'll cash flow, right? And that they're also implementing some type of tax abatement program, right? So we can then restructure the debt, right? So then part of our fund is to come in, help them restructure that debt or refinance that debt out of their 2021 loan or 2022 loan that's not doing well, right? Or is now charging an arm and a leg, into something that's a little more stabilized. And we ensure that we underwrite the property that is able to obviously pay the senior debt plus our debt, right? Our loan, our current pay. And then when we sell the property in the future, or that operator sells the property in the future, whether that's like an 18 to 36 month time frame, we'll be able to get our accrued pay, our annual accrued pay back on that, right? So it also depends on the level of investor of who comes in, right? But of what our different buckets are, right? But on average, I'd say it's about 14% annual returns, right? It could be higher, it could be lower. The second tranche we do is gap funding. So for operators that might need a little bit extra money to close their deal, and they raise us out of that, right? So that's more of a personal guarantee from the sponsors, that if they need $500 million, $2 million, then they'll be able to raise out of that in under a 3-month time frame. So we'll have a different strategy for that one. But those are the two main focuses for our private credit fund. We see that that's a lot of what we're doing. The difference between a pref equity fund and a private credit fund is that the private credit fund is a guaranteed return. Pref equity is not necessarily a guaranteed return, right? So you could have a pref equity come into your operation, but if the money is not there to pay it, then you're just going to keep deferring that, right, until the end. And sometimes you get a smaller pref equity, sometimes you get a bigger one, just really depends. But that's why we structured this one as a private credit fund vice a pref equity fund.
Makes sense. What are you most looking forward to of all those product types? Do you have a preference, or are they all your kids? Have a favorite one?
Yeah, I think the well, I guess they're kind of both in the same. Like I love them both, to death, right? They're both my babies, right? But no, it really doesn't matter to me which one is which, right? Some that we could be more risk adverse in would be, I would say, the mezzanine debt position, right, or the private the loan to the Class A operators, right, would probably be more of a risk adverse opportunity than the first time. Which again, we vet all of our operators, so we wouldn't be investing our fund into a first time operator position that we are not part of the GP teams. Now, that's also part of it too, is that if they if that team is having trouble, we might be coming in and helping them KP a deal. We might be helping them operate the deal. Our team, we've got a team of 10 folks behind us, right, that are focused on marketing and operations and asset management. So we can really bring in a good process-oriented team into the operation and help them close the deal, help them raise the money, help them get out of that fund, and also run the property successful as well too. So.
Makes sense. So wrapping up here, final question for you. You've had a sales career that's been very robust, 20 years of it. What makes a good salesperson, and how does someone navigate a 20-year-long, 2-decade sales career?
Well, I think we talked about it earlier, and I really do believe this. It's your authenticity, right? If you can be yourself in any conversation you're at, like Craig, this is, if you and I were speaking at a bar or speaking at a coffee shop or speaking at an event, like you're going to get the same Jeff either which way, right? Or if you're at home or on a golf course or you're sitting here at dinner at my house, same kind of thing. You're going to get the same Jeff all day long, right? So I love to make sure that I'm being myself and I'm not changing for somebody to try to maybe convince them to buy something from me or to invest with me, right? I'm who I am, right? And if I can be that authentic me the entire way through, that I think it shows a level of trust, and it gains a level of trust from your investors and from your clients, right? That they know the Jeff they're getting, right? I'm going to work my ass off, right, to make sure I build the right relationship with you and follow through with my word. And I'm going to do it in a good, authentic way. So.
Fair enough. If you were to go back, would you have maybe moved to a different more company here and there, maybe shifted more than twice? Or are you very happy, look in retrospect, that you were only at 2 companies for that kind of time? Did you ever think maybe there was more else out there? Or because there's a lot of the shiny object syndrome, I think, particularly with millennials, Gen Z and whatnot. So what's kind of your message on that front with sticking with 2 companies?
Yeah, really, I think it depends on the people. If you are invested, like if you're invested in a company, right, And it's because of like they're dangling a carrot or something like that or whatever it might be. But if you're in it with lockstep, arm step with that team, right? That's what keeps your motivation going and keeps you driving forward as that team mentality. I think that's very important for anybody to look at in an organization. Who is your manager? Who is your manager's manager? How well do you know them? Can you call them if you have a problem or if you have an issue? Is it a very hands off corporate environment? Like I've never been involved in a hands off corporate type environment. Both of the companies I worked for were very small businesses growing into large businesses, right? So growing with the wave of the company also helps out as well too. And if you in sales, you eat what you kill, right? So if you work your butt off, right, and you do it in a great way that provides excellent support for your customers and also provides you an opportunity to be able to make more money that you sell when you sell. I mean, to me, that's kind of the best of both worlds, right? So, I'm big on experience. I'm big on people, and I'm also big on reward as well too. So.
Excellent. Jeff, where can people find you? Where can people find your ebook, as you mentioned, or kind of reach out to book a call with you?
Yeah, I think the best way is LinkedIn. So if you go check out my LinkedIn, I guess it'd just be linkedin.com/Jeff-Ervick, I think it is. But Craig, I think you have it, so we'll put it in the show notes. And if they can't find me there for some reason, there might only be one other Jeff Ervick in the world, right? But Jeff with a J, by the way. So if you can't find me there, ValorisCapitalPartners.com will be a good opportunity there too. And I'm on Facebook as well. So if you want to reach me on Facebook also, but I would say LinkedIn is probably the best way to find me and also kind of see what we do, see what we got going on.
Excellent, Jeff. Thank you so much for your time today. I appreciate you coming on. I look forward to having you again in the future. Hope to see you in a conference sometime soon. Maybe you'll go to our flagship event in New York City, which is not too far from you, over there in Baltimore. That'll be on September 15th. Would love to have you there, especially if you're looking for more family offices and institutional capital groups, but we can talk about that more offline. For those who are listening, we appreciate your time today, and we'll hopefully see you next week.
Awesome. Thanks, Craig.